So here are problems, the hidden cost of keeping too much cash. Number one, we want to look at inflation, because inflation eats away at your emergency fund every year. As you are keeping it there, inflation is eating it up. Well, the same 50,000 naira you kept 5 years ago, today in Nigeria, looking at the situations of things and the way the economy has changed, that 50,000 naira will be worth about 20,000 naira now. Because what 50,000 naira can buy then, naira now cannot buy it, because it is less in value and it is worth about 20,000 naira now. We are, our government has done currency devaluations and there have been a lot of changes in our economy. So inflation will have eat up that emergency fund. Don't worry, I'm going to tell you a smarter way to go about it. Number two, most people never end up using the fund, the full amount they save. So they save a full amount, like I told you before in the beginning, you are earning 3 million and you have about 80 million in your account. You might end up not spending the full amount. But sometimes some people only spend about 2 million out of it. What about the remaining 60 million lying fallow there? So I will tell you a smarter way to go about it. Then another problem is that bank profit from your money while it is losing value. So you are losing that money you kept as an emergency fund, is still losing value. Okay, and while it is losing value, the bank is happy that you have the money right there. So I'm going to teach you a smarter way to go about it. So what are the smarter approach you can actually make in order to ensure that you are maximizing your emergency fund? So what's the solution? Okay, because you don't need to abandon emergency funds completely, but you have to do a rethink of it. Now I will tell you two basic things, very important, you need to take note, which are very smart way to go about your emergency funds. One, you need to just keep enough cash for 3 emergencies. And when I say 3 emergencies, I'm talking about emergencies like car repairs. Your car just broke down and you have to repair it. And like medical bills, some simple little medical bills. Your child is sick, you are sick, or there is a little issue or whatsoever that needs you to go to the hospital to get all those things sorted out. You can keep that in your normal savings account, but it won't be your 6-month savings, because that might be too large to have there. Okay, so the general rule here is, one, you want to keep enough cash for 3 emergencies. And I told you, like car repairs and medical bills. The next thing is that the rest of the money need to work in low investment or high yield account, so it grows instead of shrinking. So here is the thing, we are actually focusing more on you investing those money in short terms, low risk investments. There are some investments you can do 30 days, 60 days. You put your money there and you have it available to you within 1 month. You have it available to you within 2 months. And the interest you are going to get is going to be higher than whatsoever your traditional bank is going to give you. So let me just break these things down. These two rules I just said now, let me break it down. So smarter ways to prepare for your financial emergency. One, let's look at diversified liquidity. Now, one way by which you can be smart about your emergency fund is by diversifying your liquidity. So you mix cash with other liquid assets like short-term investment or money market funds. Okay, so you mix it. So you do short-term investments, and like I told you, there are 3-month short-term investments you can do. Now, what you want to achieve here is having access to the money anytime you need it. So if you are doing short-term investments like treasury bills, you are doing short-term investment. You also have what we call secondary market. In secondary market, you can do 30 days, 60 days, depend, because there is someone that wanted to sell and you can buy from the person. Maybe the person did 1 year, it has already done about 8-9 months, and then the person have an emergency and want to sell. In the secondary market, that can be sold. You buy it and then you use the remaining 3 months or remaining 2 months, and then you have the remaining part of the money. So there are short-term investments you can do, 2 months, 3 months, that will quickly give you back your money, and if there is an emergency, you can use it. So you diversify your liquidity. Let it be in different short-term investments. That's your emergency funds. Don't forget that I said the first rule, you have to keep the true emergencies, not just you going into the rule of 3 to 6 month investment, but rather let it be that you calculate how much is your true emergencies. So another one I want to talk about is high yield savings. If you are somebody that is familiar with some fintech app in Nigeria, One of them is piggyvest. You will see that there are some investments that are 90 days, some investments 60 days, some investment 30 days that you can go into, and they are going to pay you higher return than what you get in your traditional bank. So consider accounts offering better interest rates than traditional savings. So there are high yielding savings. They are still savings accounts, but they are high yielding savings accounts. Piggyvest have it, and we have some other apps that have it. So it's just for you to know those apps, and I'll be talking about those in my subsequent videos as well. So number 3, we want to talk about short-term investment. Short-term investment. So instruments like treasury bills can offer liquidity and some return. So if you are doing treasury bill, I told you, you can buy in the secondary market. You can get 2 free months, depending on the number of months you want, because there are people that bought in the primary market, they need cash and they want to sell it in the secondary market. So you can actually get as many months or days you want from the secondary market. So you can do all those ones with your emergency funds and get your money back as soon as possible. Now, another one we'll talk about is line of credit. When we have emergency fund, what we want to target is that we must have access to funds at all times. So we want to look at your line of credit. Access to credit can be an emergency funding option. Access to credit, that is what you want to ensure that you have. And let me tell you something. Even if you invest in treasury bills and you invest in all these investments I told you, the certificate you have can actually be used to even collect money from banks. But you might say, is it a smarter way for me to have money in my investment and I'm still collecting money from bank with an interest? It depends. If you need an emergency and you still have a bigger money, let's say you have about 20 million in your investment and you just want to borrow about 1 million. How much interest do you think you will be paying than for you to go and break that investment that you make? So with that certificate you have of your treasury bills or your investment bonds, you can actually get loan from bank with a lesser interest rate, and then you can quickly go and do whatever you want to do with it. So it gives you access to credit by you having those investments. Okay, I'm still talking about your emergency funds here. Okay, there is still the one you use for your main savings, your main investment, but this one, emergency fund of 6 months you are keeping, how you go about it is smarter way, because at the end of the day we want to have access to that money anytime we need it, and that's why it is called emergency fund in the first place. So line of credit, access to credit can be an emergency funding option. So another one I will tell you is asset allocation. So here you have to balance emergency needs with long-term investment goal. So with everything I've talked about, at the end of the day, you are still looking at your investment goal. Because like I said, you have your investments separately, but here your emergency fund that is sitting in your bank account, we are still talking about how you can ensure that you maximize it. And by maximizing it, you need to still channel it towards your long-term investment goals. So let's quickly look at some considerations, and just like I've already mentioned them, one, we want to look at accessibility, and that's the purpose of you having an emergency fund in the first place. So emergency fund should be relatively easy to access. 2, we want to look at the risk, and here you have to balance your liquidity needs, need for your money, with potential risk and returns. You have to balance it up. What's the risk I'm taking? What's the return is going to give me? Okay, and then when you have that, maybe it is a low risk investment, low return, and then is it going to provide me my money anytime I need it? Okay, so you want to balance all of those things out. And then thirdly, you want to look at personal circumstances. So you want to tailor your emergency fund strategies to individual financial situations and need. Your financial situation and need is different from my own financial situations and need. So you want to tailor your emergency fund strategies to your individual financial situations and your needs. So at the end of the day, the goal is to balance preparedness for unexpected expenses with the potential for growth and maintaining value over time. And the truth is, emergency funds are meant to protect you. They are to protect you. But if you don't use them wisely, they can quietly keep you broke. And that's why it's important you listen to what I'm saying. You have to protect yourself, but don't let fear lock your money away where it will lose value. If you have a different opinion, drop it in the comment section below. Kindly like, share, and subscribe to this channel for more videos like this. Thank you.